Okay, dear ladies and gentlemen, we will have to start with the second panel for today. I would like to apologize because we are behind the schedule of about 15 minutes, but I hope that we will catch up during the panel. So following one outstanding presentation by the Governor Jan Smets, an excellent and very lively discussion on the main challenges that the countries in the Western Balkans have been facing in the context of the new global cycle. During the second panel, we will more closely focus on one very relevant topic, which is the capital inflows in the region, touching upon a couple of very relevant aspects of this question. First aspect is to what extent has the region benefited from spillover, has had spillover effects from the abundant global liquidity worldwide, and especially from the liquidity which was injected by the European Central Bank, of course, because of the strong financial linkages that we countries in the region have with the EU. Then the second aspect will be to what extent has we benefited in terms of the capital inflows and what have been the implications of the capital inflows in the region to the real sector and to the financial sector in our economies. And the last aspect, though I would say the most important aspect at the current juncture, is looking forward, that is, what are the prospects for the capital flows in the region in the forthcoming period, and related risks to this in the context of the changing monetary policy horizon. It's my great pleasure and honor having distinguished panelists at this panel who will share their views on this very relevant topic for the central banking community and even more broadly for the policymakers across the region. So let me first briefly introduce the panelists. Next to me on my right side, I have Mr. Bakker. He is IMF Senior Regional Representative for Central and Eastern Europe. He has had various IMF positions and has worked on a range of countries and policy and research issues. He has also worked extensively on the Central and Eastern Europe, including as a head of the Emerging Europe Regional Division and Mission Chief for Bulgaria. He holds a PhD from University of Groningen. Next to us is Tom Richardson, who is a director of the IMF's Joint Vienna Institute. Prior to the GVI, he was IMF Senior Resident Representative in India, Nepal, Bhutan, and Uganda. During the course of the 20 years of the fund, he has held various high-level IMF positions, including IMF Mission Chief and Resident Representative for a number of countries. Before joining the IMF, he was assistant professor at the Yale University, and his PhD in economics is from Columbia University. By the way, Tom is also my former boss from the IMF. On my left side, next to me, is my pleasure having Mr. Jozef Bradezko, Vice Governor of the Slovenian Central Bank. He is also a deputy member of the Governing Council of the European Central Bank and member of the Financial Stability Board in Slovenia. His portfolio comprises of a number of high-level positions, including member of the Management Board of the Slovenian Export and Development Bank, Supervisory Board of the Bankers Association in Slovenia, and member of the government's Anti-Crisis Working Group. He has master's degree in economics from University of Ljubljana. Just to set the stage for discussion for this panel, I have a slide with a couple of charts that portray the capital flow trends, dynamic and structure of the capital inflows in the region. So here is the slide. What are the main takeaways from the slide in terms of the capital inflows that were redeployed in our region? Despite some heterogeneity across countries, there are some broad messages that can be taken away. First, capital inflows in the southeastern European economies, including Western Balkan economies, where we belong, have continued after 2009, but at a much slower pace compared to the pre-crisis period. If in the pre-crisis period capital flows accounted on average 16% of GDP in the region, in the post-crisis period they have decelerated to only about 6% of GDP. Putting aside Albania as an outlier country, which in fact didn't face capital outflows, but on the contrary, there has been acceleration of the capital inflows, all other countries in the region face the process of decelerated capital inflows. What is also interesting to notice, however, is that the deceleration of the capital inflows in the region continued also in the second sub-period on the charts, and this is in fact the most recent period when pursuant to the stepped-up quantitative easing measures by the ECB, which meant huge asset purchases and huge injection of liquidity, one would expect that or to see the larger cross-border flows. However, this is not taking place. Despite the lower pace of capital inflows in the region, if we compare with other, for example, with economies from the Central Europe or especially Baltic state, we can see that the deceleration that we are witnessing in our region is, however, lower compared to these economies. For example, in Central European economies, the capital flows has almost stalled. You see there is no green bar on the chart. And especially in the Baltics, although in the case of Baltics, this definitely reflects the extremely high pre-crisis levels. In terms of the structure of the capital flow, one message that comes up from this chart is that deceleration is taking place across almost all types of the capital inflows. The lowest downward adjustment in terms of the capital inflows is present in the case of a portfolio inflows that on average has remained broadly stable, I can say, ranging about 1% of GDP. Still, if we look at more granular data, we will see that there are different developments according to the sectors or recipients of the money. While there was a downward adjustment in the segment of the private sector, borrowing or portfolio investments in the government sector picked up. So, in fact, they compensated for the outflows that were present in the private sector. The highest downward adjustment from the chart can be seen that it took place for other inflows. Other inflows is defined as a residual category that includes all components which are outside FDIs and portfolio inflows, and it's only the debt component. So in this segment, the downward adjustment was highest, and also more granular data point to the fact that it can be probably to great extent explained by the banking sector, the leveraging in the region. FDIs also decelerated, but from the chart we can see that they still remain one of the most important components of the capital inflows in the region. So that's the broad picture that we can see. Here I was using the balance of payment statistics as a proxy for capital inflows in the countries in the region. Against this background, I would like to pose a question to the panelists. What they think and how would they generally assess the spillover effects from the quantitative easing policies from the US quantitative and especially European quantitative easing policies to the region in terms of the capital inflows, and also in addition to this, to what extent this size of the capital inflows that have entered our market has helped in loosening the financial conditions and that way also underpinning the recovery and the growth in the sector.
Sure. Thanks very much, Anita. And let me also just thank you once again for inviting me to this excellent conference. I really have found the discussion over the last 2 days to be excellent, and the topics raised have been really important ones. So thank you once again. I feel that the topic that you've raised just now, the impact or the spillovers from quantitative easing and looser monetary policies on the countries in the region, it's an important one, and it's one that actually I see central bankers in other regions face. As you mentioned, I worked in India before I came to the Joint Vienna Institute. I was the IMF representative there. And for a considerable period of time in the period around 2000, after the taper tantrum, so around 2014-15, there was a lot of concern, particularly by the Indian central bank, about managing the flows from quantitative easing in advanced country central banks, and whether the policy of extremely loose monetary policies was imposing additional challenges for emerging market central banks. At the same time, looking at the data that you've just shown in southeastern Europe, there hasn't been a major wave of inflows over this period. So, so what explains these two views? I mean, how you have a kind of a bit of a disconnect between the two perspectives, and I think, to be honest, my sense is that there is in the world of investment finance some prior or some bias towards big markets. So as a pull factor, countries that are bigger and likely to be, have deeper financial markets tend to attract more of the inflows, and that tends to impose more challenges for them. Whereas I think for some countries in southeastern Europe, as small economies, by global standards, the challenge is less severe from that standpoint to manage it. That doesn't mean that there's no impact, though. I mean, I think you can see inflation rates have been, quite modest in countries in this region, and I think money market conditions have also been, correspondingly accommodative. So my sense is that there is some impact, but the bigger challenge of managing capital inflows is not one that central banks in this region so much have to worry about. But if you're one of the fast-growing economies in South or East Asia, you might still have to think about it a bit.
Net capital inflows in Central, Eastern and Southeastern Europe have been very modest in recent years, and they have been much lower post-crisis than pre-crisis. And this is very different from Latin America and Asia. They have seen much larger capital inflows post-crisis than pre-crisis. Why have capital flows to Central and Eastern Europe been modest? And most importantly, banks have been deleveraging. Pre-crisis, there were large bank inflows. Post-crisis, there have been bank outflows. Between 2010 and 2013, there were some portfolio inflows, but in recent years, even they have been very limited. And most of the capital inflows these days is FDI. The only real exception of a country that has seen big capital inflows is the Czech Republic, where at the peak they had capital inflows of some 30% of GDP, which forced the Czech National Bank for massive intervention. So loose monetary policy and QE did not create a capital flow surge to Central and Eastern Europe. So this was different. So what will be the impact of the end of QE? Well, first, QE is still not done. It's still ongoing in Europe. But what is the impact of QE so far? And so what is the impact if it's going to be unwound? Well, QE is likely to have had two impacts. It has led to lower interest rates, and it's led to lower risk premia. So the end of QE and monetary tightening would therefore likely lead to higher interest rates and higher risk premia. So what will be the impact of higher interest rates and higher risk premia? Is this something to be feared, or is it welcome? And let's distinguish here between the impact of higher interest rates and higher risk premia. And we assume that interest rates in Western Europe will only be raised if growth remains strong. So if unemployment in Western Europe keeps falling, growth remains strong, inflation picks up, only then will interest rates be increased. Well, currently, if we look at Eastern Europe, real interest rates in many countries are negative. And real interest rates are negative even though unemployment in many countries is falling like a stone. In the Baltics, it's clear near pre-crisis levels. In Central Europe, it's below pre-crisis levels. In the Western Balkans, unemployment has also fallen very rapidly, even though the level is still quite high. If we look at wage growth, 2 years ago, wage growth virtually everywhere was very modest. Now we see in a number of countries it has picked up quite sharply. In Romania, it's around 16%. In Hungary, similar. Bulgaria, double digits. In the Western Balkans, it's still modest, but also there we have seen some of a pickup. With higher wages, inflation has also picked up, and in most countries it's now around 2%. In some it's no longer so modest, it's around 5% in Romania. And I told you that unemployment is coming down, and this cannot continue. In Poland it was 10.5 in 2013, it's around 4 now, and clearly it cannot continue to fall at 1.5% a year. So higher interest rates in Western Europe would be welcome. Given this very rapid declining unemployment, real interest rates are not great. It would particularly be welcome for countries in Eastern Europe that do not have their own monetary policy, and they may soon be very constrained, but also for countries with floating exchange rate. They don't live in a vacuum. They are, of course, worried that if they raise interest rates, the exchange rate will appreciate. So higher interest rates are welcome. The second question is higher risk premia. And there, in a number of countries, risk premia have declined to very low levels. And in some countries, this decline in risk premia has been despite a deterioration of policies. In Romania in 2015, the structural fiscal deficit was around 0. In 2018, it will be around 5%. This in a country where wages are growing by 16%. This is clearly not ideal. Now, in the next few years, given that strong growth in Western Europe is likely to continue, growth in the region will likely be strong as well. And in this setting, risk premia are unlikely to rise. And in fact, if you look at the pre-crisis, what did we see in many countries? That even though imbalances were increasing, risk premia were dropping. In Latvia, between 2005 and 2007, the current account went from 10 to 22% of GDP, and risk premia fell. And why was this? Growth remained strong. So the combination of low risk premia and deteriorating policies, that is what makes the region vulnerable to shocks in the future. And a combination of low interest rates and strong growth may lead to a deterioration of policies. If you can borrow very cheaply and growth is strong, there is little incentive to reduce debt levels. Why would you do it, people think? Also, with strong growth and low interest rates, public finances look much better than they are. There is less perceived need for reforms if growth is strong. Why would you reform? So this combination of low and falling risk premia with deteriorating policies, that is dangerous, because if you get a shock in the future, then you may get a repricing of risk. And then the countries which had seen a deterioration of policies, they will see the sharpest increase in risk premia. And what kind of shocks could we have? Well, a large correction in stock markets, a trade war, a big geopolitical shocks. Economists are not just awful at predicting the future, they're even more horrible at predicting future recessions, and we never see them coming. So it is good to prepare. So to conclude, higher interest rates will not harm the region, and tighter monetary policy in the West is welcome, and higher interest rates may prevent future overheating. But other shocks may hurt the region, and the longer current low interest rates environment continued, the more impact shocks may have in the future. Thank you.
Thank you. Jozef, would you like to add something?
Yeah. Work? Okay. Maybe I wouldn't, thanks for inviting me here. I wouldn't elaborate further on these general topics. Maybe I could add some figures of some general image from Slovenia. Slovenia is, let's say, some kind of schizophrenic position in this discussion, because it is part of monetary union of euro area, being a major source of capital flows to this region. Second, Slovenia is nevertheless a part of the region per se, so at the verge of Southeast Europe, and at the same time, according to some other classifications, to the Central Europe. And figures during this period more or less reflect the second and the third role of Slovenia. So more or less the capital flows stopped at the beginning of the crisis and reversed actually after 2013. And the composition of flows more or less reflects the let's say, patterns already observed by Anita. So more or less first stopped, the oil flows stopped in banking system. Portfolio flows first stopped, later on continued to opposite direction. And foreign direct investments are still the most stable, either inward as well as outward direction. Maybe a couple of one remark or two on APP per se. Bas already elaborated very extensively in this, and in very well argumented way. So maybe we could see the APP generally has do work through three channels. First is, of course, portfolio rebalancing. So if the euro system is buying securities, then other investors should buy something else. And this channel will probably work even after the APP, net new APP will stop, because the reinvestment part of the APP is already much more important than net purchase is. Approximately, I think, around 15 billion per month is some kind of average of reinvestment buying from the euro system. And this will remain even after the net APP will stop. The second channel is banking liquidity channel. You know that, okay, these banking channels are not working so extensively than it was the case before the crisis, but still banks are investing. Also, we have observed from Slovenian banking system that some banks also purchased securities for the first time, government securities from this region. So this banking liquidity channel is working, and it will continue to work due to high stock of excess liquidity, which will remain for at least a couple of years after the discontinuation of net purchase. The second channel, okay, signaling channel, which is also present and will be present. We have heard from Mr. Smets about the graduality of interest rate normalization and monetary policy normalization from the Euro system. I think in the end, the influence on the region will depend how much will be this time different, this cycle of normalization of monetary policy. Traditionally, those cycles had caused some disturbances in recipient countries. But on the other hand, I think there are some quite strong arguments that this time is a little bit different. One is that the inflation expectations are very well anchored, very low, and with very low dispersion of interest rate risk, inflation risk perceived by markets. So this well-anchored inflation expectations will definitely also limit the speed of any interest rate rise, especially on the longer part of the yield curve. The second argument is probably the very low perceived natural short-term interest rate. According to most of estimation, the natural interest rate for the euro area is negative, quite negative, close to minus 0.5%. Okay, it will rise definitely with new investments and new absorption being generated, but still it is low and will remain low. And this implies that the cycle of interest rates increase will, according to general perception by market, will stop much lower than it was the case in previous cycles. The third argument is definitely that enormous liquidity will stay in the system, and although the anchoring effects from this liquidity will also stay. And nevertheless, the last is that the fundamentals in this region, I think, are much better than it was the case in previous cycles. So, of course, all those arguments will not or would not help for some weakest countries, because market perception could change very quickly, and it's a rule that countries that rely most on the capital inflows generally suffer most during the reversal. Thank you.
Maybe Anita. Can I follow up on this? I mean, because Jozef just made, I think, a really good point. I mean, that there's differentiation across countries, and that markets do differentiate between countries when there's a tightening cycle. If we think back to the taper tantrum period in 2013, a lot of countries suffered from the global repricing or the global re-estimation of how U.S. monetary policy would be conducted. But the ones that were the most effective were the ones that had the weakest underlying fundamentals. If you think about what, at the time I was working in India, and the countries that we were at that time referring to as the so-called fragile four were India, Indonesia, Turkey, and South Africa. And they all had relatively high, or most had high fiscal deficits, high current account deficits, relatively high inflation, so worries about competitiveness. So there is this, sense that, if I interpret the underlying question behind this panel is how can we protect ourselves in the event of a tightening cycle, and particularly a tightening cycle that happens at the same time as some global shock. The best way to protect yourself is to have good underlying fundamentals, right? So that's, I think, a reason to think about fiscal stance, to think about the health of financial systems, and also to be worried about competitiveness and those underlying measures that improve your underlying external position. So
I was recently looking at the IMF, one of the IMF reports that focused on the Fed tapering effects on the countries in the region, especially covering our region of Western Balkans, and also the episode of US post-election market sell-off to see. I was really interested to see what were the effects of our countries in the region. I mean, the message that we can get from there is that, of course, the effect was not broad-based, it was differentiated, it depended a lot, as you mentioned, on the country fundamentals, and it also depended on the extent to which the countries in a prior period accumulated capital inflows, and to what extent these capital inflows were channeled in areas that created vulnerabilities or resulted in more complacent policies, and also in the countries where the compression of the risk was lowest, as Bas was speaking about the risk premium. So, I mean, looking at this data, definitely it points that all countries are not equally vulnerable, but we're definitely not isolated, and definitely fundamentals and the policies to build up fundamentals are very important. Briefly, I would like to focus on FDIs in the region. As we all know, that a small country cannot become rich without deeper integration into the rest of the world, and especially literature and the practice points that FDI are usually a good channel for higher trade and financial integration of our economies, small economies in the region. In the most recent period, there are a lot of talks about global value chains, a lot of papers by the IMF, World Bank, so focusing on a global, why there is a focus now on the global value chains is mostly because in principle they provide greater integration without countries necessarily having a developed complete products. They are part of the value chain, and plus they unlock the knowledge, technology, import the technology, and all this affects productivity, competitiveness. So how do you see developments in the region in terms of our integration in the global value chains, and what are the prospects for further integration in this venue?
I'll just say a few words. I'm very impressed by the degree to which value chains, regional value chains in Southeastern Europe, Southeastern Asia, East and Southeast Asia really had a transformative effect on a number of economies in that region. And I'm also have the sense that value chains connected to particularly the German and Central European automobile industry have also had a big impact on countries in that region. So clearly you're right, Anita, to focus attention on this. This is an important topic. I think the way international trade happens in the 21st century is not so much in terms of completed products, but in terms of components and ultimately, you know, that lead to completed products at the end. So how do you connect to global value chains? There's a huge literature on this issue, but one of the central messages has to be infrastructure. Good infrastructure, rail, road infrastructure, ports for those countries that are on the ocean. Those are critical factors for being connected to value chains. Also, ease of doing business or improved customs facilities, clearing procedures. Those are also really important. But you have to really focus on, I think, infrastructure. And there's a clear imperative for Southeastern European countries to improve road and rail transportation, maybe electricity as well. I'm not so sure, but it sounds like that might also be an issue in this region. If you want to connect to global value chains, you have to be, competitive and be able to, reliably deliver on time, according to the standards, and that requires, really good infrastructure and also good human capital. I think you have to have educated workforce that understands how to interact with higher technology, production technology. So those are challenges to address, and I think there's a lot of room for Southeastern European countries to make progress in that area.
Let me first make a remark on the idea that FDI always is so great. Not some forms of FDI can actually increase vulnerabilities. Bulgaria in the pre-crisis years had very large FDI inflows. The problem was that these FDI flows were largely in the non-tradable sector. So they don't generate new exports, but they generate a lot of extra domestic demand and imports. So the FDI inflows contributed to a large current account deficit. FDI in the banking sector has a similar effect. So what you really want is FDI in the tradable sector, and the Czech and Slovak Republic and Hungary have been really good in attracting FDI in the export sector, making the economy more open, generating very rapid growth that also was sustainable. So FDI in the tradable sector would be great, would lead to higher exports, higher growth. How do you get more FDI? Well, if you look at German firms have invested particularly in their neighboring countries, Czech, Slovak, Hungary. Unfortunately, Southeastern Europe cannot move closer to Germany. So either in the most ideal circumstances, they would not attract probably as much FDI as countries closer to Germany. But even so, they can become more attractive. I think the number one thing that would help is EU membership. EU membership sends a signal that policy frameworks and judicial system in the country meet similar standards as in Western Europe. So that takes away a big unknown of foreign investors who currently may not know how to assess the system. And the countries are very small anyway. If there is a big country, you may invest some time in finding out how the country works. But if it's very small, probably many investors don't bother. And once the region becomes a member of the EU, it has this kind of seal of approval, and it makes it much more attractive for investors. Also, of course, in the run-up to EU membership, countries adopt a acquis communautaire, so the whole framework will be improved, and it will improve the economy in general. So, in short, FDI is not always good. In the tradable sector it is, and EU membership would help attract more FDI.
Thank you, Bas. Just maybe to mention that maybe Macedonia is a good example, in fact, of channeling the FDIs in the tradable sector. If we compare the data in the pre-crisis period, about 2/3 of the FDIs were channeled in the non-tradable sector, but in the post-crisis period, because of a lot of measures to boost the FDIs in the tradable sector, opening free economic zones, practically the structure of the FDI inflows has been changed in a positive manner. And this morning, Governor was discussing the structural changes in Macedonia. I think that's one of the key factors, because they changed the production structure of the Macedonian economy, exports towards new higher value-added products. And in fact, this is a good example that entering the global chains can have a lot of benefits for the economy. Jozef, maybe your experience in the case of...
Maybe Slovenia joined the EU in 2004, and we indeed observed quite increased participation in global value chains in a period of approximately 4 years after the joining the EU. So-called let's say, backward participation for those of you who maybe deal with this area. Slovenia joined this project of world input-output statistics, which enables us to assess such effects in quantitative terms as well. And backward participation is a share of exports that come from imported intermediate goods. So the higher it is, more it is probably that this is part of global value chain. And indeed, the share of this indicator increased by 7 percentage points in case of Slovenia. Now it's approximately 40% of our gross exports comes from imported intermediate goods. In contrary to theory, when Slovenia joined the EU and this integration in global value chains increased, the current account deteriorated during this period, in contrary to what the theory predicts. Actually, approximately 5 percentage points during this period, but could be attributed as well to other factors, cyclical. And some other, let's say, political, fiscal policy and so on. It is interesting that in the industries that Slovenia is considered to be, let's say, more competitive. In those value chains, the share of locally value added in total export is higher in comparison to other countries. And for example, automotive parts, transport equipment, also pharmaceutical industry. So this value chain statistics and theory could help a country to build some kind of, let's say, industrial policy. It could be a useful tool. Maybe two remarks more on negative negative consequences of participating in value chains. We have observed that, especially for the companies which are based on the beginning of the value chain, during the slump in 2008-9, those companies were hit much harder than companies which were higher in the value chain. So being at the very beginning of the value chain adds to procyclicality of domestic activities in the case of, especially in the case of slump of foreign demand. The second is maybe, okay, it's not a drawback, but nevertheless observation from Slovenia and let's say mostly automotive industry, but I think this pattern has spread to other sectors as well, that the final producers of consumer goods are pushing the development costs of the intermediate products to producer of intermediate products. So this, let's say, Lohnarbeit of previous years, that you get an order from the foreign country, you get a technology, you get even working capital and so on, does not work anymore. If you are integrated, especially in those industries with higher, let's say, higher valued products, you should be prepared to develop your own technology, to finance this technology, to finance your own working capital, and to do it in a forward-looking period of, let's say, 3 to 5, even 7 years in automotive industries. So it is becoming very, very capital intensive as well, very knowledge intensive, and I think it is some kind of permanent shift in way how the value chains are operating now.
Mm-hmm.
Thank you.
Yes.
Just one follow-up point on this. I mean, I think the more I think about the issue of connecting to global value chains or regional value chains, I think about the importance of intra-regional trade. Right? I mean, my sense is that within the Western Balkans region itself, there's not as much trade amongst countries as you would expect. And so that to me, maybe that's also a place to start. If there are physical infrastructure barriers that make it difficult to trade across borders in this region, or customs clearance procedures or other business practices that make it difficult to trade across borders in this region, that's an important area perhaps to work on. I think from other parts of the world we see that landlocked countries that don't have access to the sea, are particularly pressed and have a particular incentive to improve those kinds of customs procedures and improve also the infrastructure for trade. And Macedonia obviously is one. Ohrid is as beautiful as any sea, but it's not connected to the ocean, and so you do have, I think, a strong incentive to improve customs clearance procedures to make it easier to trade across borders and with your neighbors.
Yeah, I think you are definitely right. When we look the data of intra-regional trade, is really disappointing. So low level of trade among the economies in the region, and in fact, higher integration, I think, will also help through the economy of scale factor, the integration with the global value chains. Okay, so maybe just now shift to other capital flow, banking system flows in the region. We saw from the data that banking systems in the region were one of the segments which was most heavily affected by the deleveraging process, which is evident. But looking prospectively, what can we expect? What kind of trends in the banking systems we can expect, especially having in mind the new regulatory overhaul changes which are implemented at the level of the EU, also in other countries, new Basel regulation, and related to this changing banking models. In maybe one sub-question in this segment is also a role of Vienna initiative as a platform where all the stakeholders of the banking systems in the region, I mean private and public stakeholders, get together and try to coordinate in order to mitigate any possible adverse effects.
Great. I'll just say a couple of words on this. I mean, at the Joint Vienna Institute, we're quite proud of the fact that first meetings on the Vienna Initiative actually took place at the JVI. And so we feel like the Vienna Initiative is an important platform and vehicle for coordination across the region. And I think, and there, my sense is that there is a role for a platform or a forum like that for coordinating policies, particularly if we, as we've heard this morning and yesterday, if we worry that we could be, on the way towards some future tightening in conditions which could impose that kind of burden. The only other point I would make on the on banking sector flows is that clearly there is a role for tackling non-performing loans and bank balance sheet quality. There's been a lot of progress. We heard that this morning, and so many countries in the region have reduced NPL levels, and there has been a lot of progress. But I think there's still some way to go in that area, and I think the underlying structural measures that improve the flow of, or the quality of banking sector assets, like insolvency regimes and bankruptcy regimes, those are going to be really important. So I think that it's important to focus on those as a way, ultimately, of mobilizing banking sector flows.
Mm-hmm. Thank you. Lars, would you like?
In much of Eastern Europe, most of the banking system is foreign-owned. And pre-crisis, Western European parent banks had a different model than they had now. Pre-crisis, funding was centralized. And so in particular countries, there did not need to be any link between domestic deposits and domestic credit. And in countries where credit was growing very rapidly, there would be capital and funding from the parent bank. For example, in Latvia, domestic credit increased to 90% of GDP, but domestic deposits were only 30% of GDP, and the rest was funded by parent banks. So this funding model helped create very rapid growth in the pre-crisis years, but it also turned out to be very vulnerable when, after Lehman Brothers, Western banks came under funding pressure themselves. They stopped sending capital and funding to Eastern Europe, and it contributed to a very deep recession. So in recent years, the capital and funding that came in the pre-crisis years has gone back. Now in most countries, domestic credit and domestic funding is in line. Going forward, I think that Western parent banks will stick to the model where domestic credit is domestically funded. That means that credit growth may not be as high as in the past, but it also makes the region less vulnerable. I think we are done now with deleveraging. Do I think there will be large new inflows from banks? No, I don't think so. I think it will be near zero. Finally, on the role of the Vienna Initiative. The Vienna Initiative was started in early 2009 when there was a worry that banks would withdraw precipitously from Eastern Europe. And the worry was that if banks were convinced that other banks would withdraw, it was best for them to be first. But of course, if all banks thought the same, they would all withdraw, and it would end up in a situation that was in which everyone would be worse off. So the Vienna initiative was started, and banks made commitment to stay in the countries. And in countries where there were IMF programs, there were written agreements with banks that they would keep their credit lines so that IMF loans would not be used so that banks could get their funds back. This was, by and large, a success, a great success. And in 2011, there was talk of winding down the Vienna initiative. Then the euro area crisis hit, and deleveraging from Western parent banks in Eastern Europe picked up, and the Vienna initiative was restarted to help prevent this. I think the Vienna initiative has been a great platform for everyone to meet. Whether Vienna too has been successful in mitigating deleveraging, I have my doubts. The banks that came to the meetings always professed how committed they were to the region, and then if you saw the next quarter the data, nothing had changed. The deleveraging continued. That does not mean Vienna initiative is not useful. Maybe without it, the deleveraging had been even larger. But has it played a big role in the past few years? I am a bit more skeptical than about Vienna one. Thank you.
Okay, thank you.
Maybe.
Yes.
Thank you. I completely share this view that bank-to-bank capital flows are more or less obsolete. This idea to attract or to try to avoid these flows are not relevant anymore. The current regulation and market view of such a bank, having a loan-to-deposit ratio above 120, for example, or in this range, will not be possible in the future, and this is definitely, very probably some kind of permanent regime for the future. So the capital flows through bank-to-bank arrangements are more or less will be negligible. There is some scope maybe of capital flows to bank to corporate, foreign banks to domestic corporates. This market remains, but it is one of, let's say, most volatile part of capital flows. It's not something for the country to rely on as a policy supported approach. Maybe the third channel is also the third channel are international financial institutions. Okay, those flows are not very large, but nevertheless, at least in Slovenian case, proved to be anti-cyclical. Maybe the only channel of capital that were anti-cyclical during the 2013, especially during 2013 second dip, and those EIB arrangements, EBRD, also domestic development banks could do something in this area. The domestic state-supported guaranteed scheme also could be beneficial in this context. But yeah, in this narrow sense of banking capital flow is more or less obsolete.
Thank you. Given the time schedule, I have the last question for the panelists. So briefly, for the end, overall, will the monetary policy normalization imply lower or more volatile capital cross-border flows? and whether we should stick to the well-known recipes that the countries should rely on traditional policy instruments such as combination of macroeconomic policies, flexible exchange rates, stable fiscal policy, or even we should more focus on the global financial cycle that is deemed to put some constraints on the domestic national monetary policies, and thus calling for more capital flows, whether directly or indirectly through the macroprudential policies. I mean, discussion about whether there is dilemma or trilemma now. So whoever would like, yeah.
I'll start again. I mean, I think the big macroeconomic question you raise is an important one, and obviously, I mean, I think as economists we have to be humble, right? We have to be candid that the textbook models of macroeconomics, you know, aren't always as useful at predicting where policy should go. And I think we need a little bit of humility as we head into the next period. I think one of the things we have trouble predicting is where we are in the business cycle. I think there's a pretty clear sense that at the moment we're towards the top of the business cycle, that output is above potential in many countries, and that kind of suggests that that a downturn is if not imminent, it's coming at some point. So that means I think it's important to build up right now the buffers or the safety net for a future downturn. I think that is an important area to focus on. I think there is a tension, though, between the desire to fix the roof while the sun is shining and not when it's raining, right? And the desire to tackle these long-standing issues that are impediments to competitiveness, like infrastructure development, right? So you have a clear sense that you want to build good infrastructure to be more competitive. Interest rates still look pretty low at the moment and look pretty stable, so it looks like a good time to invest in big projects. On the other hand, if you think that the cycle could turn, maybe you need to think twice about which projects, and you only invest in those big projects that are really clearly highly valuable. So my feeling is that there is some reason to be a bit cautious at the moment.
I'm not sure that the idea that if the ECB starts raising rates, capital flows to the region will fall is correct. And I could even see that they might pick up. If you look at the pre-crisis boom years, in the years 2005 to 7, the ECB was raising rates, and capital flows to the region increased very sharply. In 2007 was the year with the highest capital inflows. And it depends a bit what the economic environment is. If the economic environment is the ECB raises rates because growth is strong, in this setting growth in Eastern Europe will be even stronger. And if you have a moderately strong Western Europe and a very strong Eastern Europe, capital flows to the region may well pick up. And so the dilemma, the problem for Eastern Europe in the next few years may not be too few capital flows, but too many capital flows. And in this environment, strong growth, possibly also more capital inflows, some countries clearly have policy instruments. The countries with floating exchange rates, particularly the large one. The countries that will have a much more difficult situation is the countries that don't have their own monetary policy or have a fixed exchange rate. In these countries, they will have the trouble as the economy starts heating up, as wages and inflation rises, real interest rates drop. So the economy heats up and real interest rates drop, and that will make the boom even stronger. A second risk in this situation is you think everything looks great, so you don't need to do any reforms. Moderate fiscal deficits look fine, so you stop fiscal consolidation. The problem with that is that during boom times, we always tend to make mistakes. How much of it is cyclical and how much is structural? In many countries, we always think that output is a little bit below potential. Then a crisis comes, and a few years later we realize that this assessment was quite wrong. In fact, during the boom year, we were a lot above potential, and we were also wrong about how much potential output growth was. And this mistake we make again and again. So what is good during good times is to assume that part of the good times are cyclical. And I mentioned that in much of the region, unemployment is falling by 1.5 percentage points a year. That's not a sustainable growth rate. A sustainable growth rate is one in which the unemployment rate is constant. You can for a while grow faster, but not permanently. That means that the sustainable growth rate in the region is a few percentage points lower than now. And it would be good to base policies on that insight, to base fiscal policy on it, and to make sure that policies boost your sustainable growth rate, they boost productivity, and are not focused on the cyclical point only. So the big challenge for the next few years is to make sure that policies do not deteriorate during good times, because then you may get the combination of too low risk premia and deteriorating policies, and that's a very toxic mix when the next shock hits.
Very briefly, I do share this view that some kind of controlled normalization of monetary policy and interest rates are beneficial for the region. What is maybe on the downside is probably that in such a tightening cycle could induce or could increase the risk that the markets could react to some third or exogenous political events in more abrupt way. So just the risk of reaction to some kind of third exogenous events will increase probably, but a normal cycle baseline scenario is probably beneficial for the region. Mm-hmm. Thank you.
Okay, thank you. Now I think we have some time for a couple of questions for the audience. I open the floor. Anna? Anna.
Good afternoon. Anna Mitrska from the Central Bank of Macedonia. One specific question I have related to the IMF. Not so long ago, there was ECB occasional paper tackling the issue of the capital flows volatility and the role of the IMF. Do you think that there is some scope, some room in the IMF toolkit, both in terms of the surveillance, in terms of the lending policy, where modifications should be done or can be done to provide the countries with a better support to cope with more volatile capital flows? We have seen recently that the IMF has done efforts, particularly in the Article 4 surveillance, augmenting it with a macrofinancial assessment of the balance sheet risks. But do you see some more room for modification or improvement in that respect? This is one specific question, and one general. There are views that, of course, the accommodative policy has helped in many respects, including the possibility to increase the risk appetite when there is a recession and global crisis. But there are views that might be that excessive risk-taking has occurred and it's present currently latently on the financial markets. It can burst and then create some adverse feedback loops, as we all know. Would you agree with this? What is your view on this issue? Thank you.
Let me start with the second question. I think there is a broader problem with monetary policy. Monetary policy is currently in most countries focused on inflation only. So if inflation remains low, we keep interest rates low. Now I think the problem is with economics, we don't have good models for inflation. Say the standard models are based on an economy. If output is above potential, inflation starts to accelerate. If output is below potential, inflation decelerates. So if the world were to behave like this, monetary policy would be very simple. Now, in practice, it doesn't work like this for several reasons. First, due to globalization, firms in many countries are price takers. So if wages rise, their profit margins get reduced. They don't raise prices. That means even if output is above potential, you may not have rising prices. You have had the entrance of China, which has had dramatic downward pressure on prices in many countries. That means even when unemployment is low, prices remain low. You also have commodity prices are very important for inflation. And commodity prices are not determined by growth in any specific country, by what happens with the world economy. And they have a very big influence on inflation. So in recent years, inflation in many countries has remained very low, even though unemployment is now very low, and even though, according to IMF estimates, output gaps in advanced countries are now closed. But if central banks focus on inflation only and not on other indicators, then of course they keep interest rates low. Then, as you rightly pointed out, low interest rates have negative side effects. They boost asset prices, they lead to risky investments. These are always great during good times. They get painful during bad times. And probably one mistake that was made in the pre-crisis boom years, that interest rates were kept too low for too long. That led to huge imbalances, a housing price boom in the US. It contributed to credit booms in many countries, in the US, in Eastern Europe. If monetary policy had been tighter in the pre-crisis years, the global crisis probably would not have been as deep. And there is a good question whether 10 years from now, historians will have the same view about the current time. There may be a risk that 10 years from now, we will also conclude that our estimates of potential growth and output gaps were too optimistic, that in fact we are now well above potential instead of at potential. And maybe we should already have raised interest rates. Based on our current best estimates, this is not the case, but maybe 10 years from now, we have a different view. Then your question on capital flows measures. Pre-crisis, economists were much more convinced of the benefits of free capital flows than they are post-crisis. We still think that in general free capital markets are good, but at times you can have problems that capital flows get too large and they may do too much damage. And if this is the case, rather than just letting it go and offsetting the damage, now the idea is sometimes it may be better to prevent the large capital flows in the first place. But this is a measure only to be taken in extreme circumstances. There is a reason why economists are for free capital flows, because if you do not have free capital flows, you get a lot of other very costly distortions in the economy. And you get evasion, you get bribery, capital starts to flow to the most favored sectors instead of the most productive sectors. So economists have favored liberalizing capital flows for a reason. And within Europe and in current circumstances, I don't think there is a large risk of getting large capital flows to many countries. Within the EU, there is hardly any room for capital flow measures anyway. So do I think there is a need in the near future to expand the arsenal of capital flow measures? I do not think so, but should there be circumstances in which capital flows were to surge, and should this create dangerous situations, then we would certainly think about whether it would be necessary to expand this arsenal. You have to add something?
We have more questions. Yes, Bishop?
I have a question. Previous year, Western Balkan countries grew by 2.8% on average. On the other side, we see that there is no capital inflow, it's reduced, no FDIs, even banks' capital inflow is very low. On the other side, Trump is saying America first, and now they say we do not like anymore so much open economics. How the region to attract capital for growth and to increase openness? And obviously private capital do not have incentives, but what international multilateral financial institutions, what IBRD? Can we see for Balkan region asset purchases by EBRD?
Who would like to take the question? Bas?
There was supposed to be an EBRD representative in this panel, but unfortunately he was sick. On your question on capital inflows, capital flows are indeed much lower than in the past, but they are far from negligible, and there is quite a nice amount of FDI inflows. It would, of course, be nice to have more FDI inflows in the tradable sector. And there are, of course, many things that countries can do to attract more FDI inflows. One is if the countries would become EU member. We saw in the new member states a big increase in FDI in the 2000s when they became member. Of course, this is not just up to the Western Balkans, but also to the EU. Reforms would help if you look in terms of effectiveness of governance. The region does not score as well as Western Europe. Judicial systems are not as strong. There is education is not always as good. So there are a whole lot of reforms that you can do to improve the supply side of the economy. that will make it more attractive to invest here, that will boost investment and that will generate stronger growth. And what Europe has and what other continents do not, and which is not always known even among economists. The EU is the biggest convergence machine in the world. We have had a dramatic success that EU countries and candidate countries have seen dramatic convergence, so countries that were initially poor have grown a lot faster than countries that are richer. You would think, but this is natural, that countries that are poorer grow faster. In practice, it is not so clear. If you look at Mexico, Mexico is near the United States. There has been a lot of trade integration through NAFTA. Economic policies in Mexico in the last 25 years have been quite decent. It's hard to complain very much. But Mexico is poorer now relative to the United States than it was in 1960. This is really amazing and stunning. A country next to the US that has not caught up with the US at all. And Europe is very different. Countries have converged with Western Europe. And what we also have seen since the abolition of communism, countries that have reformed more and reformed earlier have become richer and richer faster than countries that did less reforms. I know reforms are not always popular, and in the short term they may be painful, but Eastern Europe is an extremely compelling case that if you do reforms, you get richer. Thank you.
Thank you, Bas. I think we are approaching the end of this session. What we can say that we had a very interesting discussion by the panelists. We touched upon some of very interesting aspects of this topic. I think definitely we can say that higher financial integration and higher capital inflows in the region bring a lot of benefits to the countries in the region, but also entail a lot of risks that need to be managed properly. The better we manage the risks and prevent creation of vulnerabilities in our economies and strengthen our fundamentals, we will definitely be in a better shape to cope with any unpredicted global financial shocks that might come somewhere on the horizon. Let me once more thank the panelists for their fruitful discussion, and in the same time invite Governor to close the conference. Thank you.
Let me at the end of the conference say a few remarks, concluding remarks, to summarize the discussions that were going on these 2 days. It is obvious that the last global crisis that remained for almost a decade affected macroeconomic performances and led to slowdown in real convergence, financial integration, and in capital flows. Facing the new global cycle, the central banks must choose the right pace and proper communication for exiting from accommodative monetary policy stance. Besides strengthening of the banking standards worldwide, regulatory authorities need to reinforce monitoring over underlying and new banking risks arising at the age of digitalization and globalization. The southeastern European countries need to continue with their sound macroeconomic policies and structural reforms agenda, making efforts to intensify the catching up to the advanced economies. Additionally, that's the way how they can improve the fundamentals and therefore became better prepared to face with the new global cycle and the tightening of the global financial conditions. This means many challenges and a lot of work in front of all of us. Finally, a decade after the start of the last global crisis, we are all more experienced in dealing with risks and facing with uncertainty. That makes us more flexible to the novelties of the new global cycle. Between the old challenges, not to forget the need to further work on developing research at the central banks is an important tool for facing with the upcoming risks and uncertain environment. In this view, I'm very glad that we have already organized 7 research conferences in the last 7 years, and I'm also glad to say that each of them was better than the previous one. This year, for the success of the conference, let me first thank to Governor Smets for his keynote lecture, and thereafter Governor Vujicic, Governor Seiko, Governor Mehmeti, and to Peter Sanfey, all of them for participating in the governance panel. In addition, many thanks to the high-level participants of the second panel, Bakker, Tom Richardson, and Vice Governor Jozef Bradezko. Many thanks to all presenters of the papers, who are, by the way, excellent, and to all discussants for their valuable contribution, as well as to the all audience. And at the end, maybe the biggest gratitude to the team who organized this conference and took care everything to go very smoothly. So Anita, and all the team that was working very hard to make this conference successful. Thank you for coming. Thank you for coming and attending the conference. It was our pleasure to host you, and I hope you'll come again next year. Thank you.